What if I told you that the next 4 years could make or break your retirement? Not your health, not your investments, but your tax plan. Because of a major shift in US tax law, signed and sealed, millions of retirees just got a once-in-a-generation opportunity to protect their retirement income from the IRS. But here's the catch. If you ignore this window, you may end up paying thousands more in taxes year after year for the rest of your life. This isn't fear-mongering. This is reality. And for seniors living on a fixed income, this could mean the difference between retiring with peace of mind or running out of money in your 80s. Let's break it all down. Here's what you need to understand right away. Most retirees in America will see a spike in their tax bills by 2029 if they don't act smartly between 2025 and 2028. Why? Because two of the most powerful tax breaks for seniors, a higher standard deduction, a brand new senior bonus deduction, are only available for 4 years, from 2025 to 2028. Let me be blunt. If you sleep on this, you'll likely pay higher taxes on your IRA withdrawals, miss out on low-tax Roth conversions, lock in higher taxes on Social Security benefits, and face larger required minimum distributions, RMDs, later when your deductions are smaller. It's like a tax sale with an expiration date. If you don't buy while it's on, you lose forever. Before we go deeper, here's a powerful, simple truth. In 2025, a married retired couple over 65 can make up to $46,700 in federal income taxes. Let that sink in. That's your tax-free zone. And it's only possible because of this new law. Compare that to a few years ago when that number was closer to 27,000. That's a 70% increase in tax-free retirement income. But it won't last. So, let's explore exactly what changed and what smart retirees like you can do about it right now. What's actually in the new law? Let's explore these two powerful tax changes in detail: permanent lower tax brackets and the bigger standard deduction, and why they matter so much for seniors and retirees living on fixed incomes. 1. Permanent lower tax brackets. Before this new law was signed, most financial experts were planning for a much less favorable future. That's because the Trump-era tax cuts, passed back in 2017, were set to expire at the end of 2025. If nothing had been done, tax rates for virtually everyone would have gone up. For retirees especially, that would have meant paying more taxes on their IRA withdrawals, Social Security income, pensions, or investment gains, at a time when every dollar counts. But the new law changes the game. It locks in those lower tax brackets for good. What does this mean? Previously, a chunk of your income might have been taxed at 15%. Now, that same income will be taxed at 12%. If you were being taxed at 25%, you'll now pay just 22%. Those in the old 28% bracket will now stay at 24%. This may sound like a small shift on paper, but over the course of retirement, especially if you're living 20 or 30 more years, it can mean thousands or even tens of thousands of dollars in savings. This is especially important for seniors because many rely on taxable income from sources like traditional IRAs or part-time work. Even modest income levels can get pushed into higher brackets, particularly when required minimum distributions, RMDs, kick in at age 73. Locking in these lower tax brackets means more of your money stays in your pocket, not in the hands of the IRS. For example, let's say you and your spouse withdraw $50,000 per year from your IRA. Under the old brackets, that income would have hit higher tax thresholds. But now, with permanently reduced rates, that same $50,000 might fall into a lower bracket, meaning you owe less tax on the exact same income. For retirees who are considering Roth conversions, where you move money from a taxable IRA into a Roth IRA and pay taxes now instead of later, this becomes even more powerful. You can convert more money while staying in a lower tax bracket, which reduces your long-term tax burden significantly. And because Roth IRAs don't have RMDs, this gives you more control over your taxes as you age. 2. Bigger standard deduction. Now let's talk about the second major win for seniors, the expanded standard deduction. Starting in 2025, the base standard deduction rises to $31,500 for married couples filing jointly and $15,750 for single filers. That means the IRS is letting you keep a larger portion of your income tax-free, automatically, without having to itemize deductions or file complicated paperwork. But it gets better if you're over 65. Seniors filing jointly get an extra $1,600 per spouse, and single seniors get an additional $2,000. So a retired couple over 65 will now have a combined standard deduction of $34,700. That's $34,700 in income they can earn or withdraw, completely shielded from federal income tax. For retirees living on Social Security and small IRA withdrawals, this is a huge buffer. Many will find they can avoid federal taxes entirely if their income stays within that range. It simplifies tax planning and gives peace of mind. And if you combine this with other credits and smart withdrawals, you could live well in retirement and pay little to no federal income tax. This isn't just a minor policy update, it's a structural shift in how retirement income can be taxed. But remember, some of these benefits, like the senior bonus deduction, have an expiration date. The time to act is now. Now let's talk about the real star of this law. The senior bonus deduction and why it could completely reshape how smart retirees structure their income for the next 4 years. Starting in 2025, a brand new benefit is being introduced for Americans aged 65 and above, the senior bonus deduction. This is not a small tweak or a minor adjustment, it's a major policy shift designed to provide direct tax relief to older Americans. For each qualifying individual who is 65 or older, the IRS will now allow an additional $6,000 deduction on top of the existing standard deduction and senior add-on. In simple terms, that means a single retiree over 65 will get an extra $6,000 off their taxable income. And for a married couple where both spouses are 65 or older, that bonus becomes $12,000. Now here's the part that makes this deduction truly special. It applies whether or not you itemize your deductions. Traditionally, many deductions, like mortgage interest or medical expenses, require you to give up the standard deduction and go through the itemized route. But this new senior bonus doesn't require that trade-off. It stacks right on top of everything, no questions asked. It's automatic. If you're 65 or older and meet the income qualifications, you get it. So, let's put this into perspective with some real numbers. Let's say you and your spouse are both over 65. Your base standard deduction as a married couple will already be $31,500. Then, because of your age, you receive an additional $1,600 per spouse, so that's another $3,200. Now, with a new senior bonus deduction, you add another $12,000 on top of all that. The result? You now have $46,700 of your annual income that is fully protected from federal income tax. Think about what this means. If you live on Social Security, a small pension, and modest IRA withdrawals, your entire annual income could fall under that threshold. That means you may legally owe zero federal taxes, without hiding income, creating complex trusts, or jumping through financial hoops. For single filers, it's also a huge win. The base deduction is $15,750, the senior edition brings it up by $2,000, and the senior bonus adds $6,000 more. That's a total of $23,750 in tax-free income. But there's one critical point you must understand: this deduction is temporary. It is not permanent. It is available for only 4 years, from 2025 through 2028. After that, unless Congress takes action, which is far from guaranteed, this deduction will vanish. Gone. Erased from the tax code. This creates a rare window for strategic tax planning. Retirees who take action during this 4-year period can drastically reduce their lifetime tax liability. Those who ignore it may end up paying more in taxes down the road, especially when required minimum distributions, RMDs, and Medicare premiums start climbing. So here's the bottom line: if you're 65 or older, the government is giving you a temporary tool to shield more of your income. Use it wisely. because once this deduction expires in 2029, you can't go back and claim what you missed. The window will be closed, and with it, a once-in-a-lifetime chance to secure your financial future. But here's the warning. The senior bonus deduction is a powerful but short-lived benefit. Starting in 2025, retirees aged 65 and older will receive an extra $6,000 deduction per person, on top of the regular standard deduction and senior add-on. For a married couple, that means up to $12,000 of additional tax-free income every year. But here's the catch, this deduction is temporary. It only applies for 4 tax years, from 2025 through 2028. After that, it is set to expire automatically. Unless Congress takes specific legislative action to renew or extend it, the deduction will be eliminated starting in 2029. Given the current political gridlock in Washington, many financial experts believe the chances of this benefit being extended are slim. That means retirees have a clear and limited 4-year window to take advantage of this tax relief. This isn't just a detail to remember, it's a deadline to act on. Whether you're planning Roth conversions, investment gains, or IRA withdrawals, the next 4 years could be your best and only opportunity to lower your lifetime tax burden. Once 2028 ends, this door closes, and with it, a rare chance to optimize your retirement strategy. But how to use this 4-year window smartly? Now that you know the opportunity, here's how to actually use it to save real money. Strategy 1. Roth conversions. Roth IRAs grow tax-free. Withdrawals are tax-free. And there are no RMDs. Use this 4-year window to convert part of your traditional IRA into a Roth. Do it in chunks, staying under the new higher deduction limits. Example: retired couple makes $40,000 a year. They convert $6,000 of IRA into Roth. Total income, $46,000. Owe $0 in federal tax. Magic, right? After 2028, this exact same move could cost you thousands in taxes. Strategy 2. Harvest long-term capital gains. Have mutual funds or stocks in a brokerage account. You can now sell some of those winners, lock in gains, and pay little or no tax. Why? Because if your taxable income is under $89,250, married, or $44,625, single, your long-term capital gains tax rate is 0%. So if you sell and reinvest within this window, you can reset your cost basis and reduce future tax pain. Strategy 3. Withdraw strategically from pre-tax accounts. Pre-tax accounts like IRAs or 401(k)s sound great, but eventually, Uncle Sam wants his share. Use these for years to withdraw gradually at low tax rates. Delay higher RMDs later. Balance income sources. Think of this as a smoothing strategy, spreading taxes out gently, instead of waiting and getting hit with a tax cliff in your 70s. Beware the phase-out rule. There's one twist to the senior bonus deduction: it begins to phase out at higher incomes. Starts at $75,000, single. Starts at $150,000, married. For everyone above that, your bonus is reduced by 6 cents. Example: if you're $10,000 over the limit, you lose $600 of the bonus. So be careful. Large Roth conversions or investment sales could push you over. Work with your advisor to avoid crossing that line unintentionally. Let's recap the reality. You now have a 4-year tax window unlike any other in modern retirement planning. You can make up to $46,700 tax-free as a retired couple. You can use this to convert to Roth, harvest gains, optimize RMD planning, lower future taxes. But here's the bottom line. If you wait until 2029 to think about taxes, you've already lost. Smart retirees act when the opportunity is in front of them, not when it's gone. What to do now? Here's your action plan. Step 1. Run a tax projection. Sit down with your tax advisor and simulate your taxes for 2025 to 2028. Factor in all income sources. Step 2. Explore Roth conversions. Look at your IRA or 401k. Run conversion scenarios that stay under the deduction limits. Step 3. Review investment accounts. Have a brokerage account? Consider harvesting gains before 2028. Step 4. Create a four-year withdrawal strategy. Avoid large spikes in income later by using this window to balance withdrawals smartly. Step 5. Document everything. Tax law changes are complicated. Keep written records and annual tax projections, especially if you plan to convert or harvest gains. Retirement isn't just about how much you've saved. It's about how much you keep. And right now, Uncle Sam is giving you a chance to keep more of what you've earned. But he's only giving you for years. Ignore it, and you'll face higher taxes in your 70s and 80s, when you can least afford it. Use it, and you'll sleep better knowing your retirement is built on a foundation of smart, tax-efficient planning. So don't wait. Plan now. Act now. And make these 4 years count.